Hello again, everyone. This is Gene Ahrensberg coming to you from our HQ in beautiful but hot as blazes southeast Texas near Houston on Sunday, August 26th, 2012. And since we are here in Houston, we cannot let the news go by without commenting about the passing of a true American hero, Dr. Neil Armstrong, the first man to set foot on the moon 42 years ago. He died yesterday. You know, I'm old enough to remember being glued to the TV set back then in 1969, watching the grainy images with my family, and then going outside to look up to the moon with binoculars to see if I could see the lunar lander. And you know what? I convinced myself that I could actually see the golden colored craft on the lunar surface. "There it is," I said. "I see it." Of course, I yelled that to no one in particular. I was the only one outside with the mosquitoes. And of course, that was just my imagination then. But like many a young pup, I was inspired and energized by the success of NASA's Apollo program back then, and intensely proud that Houston played so big a part in the story. Well, today it's not a gold-colored lunar lander that has our attention, but instead it's gold itself, which this week broke out of a tight consolidation and blasted off higher like a rocket. As we can see on the closing table, gold closed up $54 or 3.4%, and silver answered big time with a big pop of $2.73 or a whopping 9.7%. As everyone who has been watching these video updates knows, we have been expecting gold and silver to break north out of their respective bottom-looking consolidations, and as the whalers might have said, "Glory be, thar she blows." Looking briefly at this subscriber gold chart, this is the daily chart. Not only has gold blasted higher out of a tight consolidation, it has already traveled up to challenge the upper implied resistance formed as the downtrend line of a giant flag or pennant formation, which has contained gold ever since its all-time high peak near $1,923 last September. Gold is quite literally on the verge of breaking out again. Let's look at the weekly chart. And here's the weekly chart. And notice that gold is right up against that upper downtrend line that forms the flag or the pennant formation, this large consolidation. If it does break out here, there are only a few levels of known technical resistance above about, say, $1,720 or so, with the most important being up around the $1,790s to $1,800, the important turning high back in February. Now that may be 7% higher than here, and it may look like acres and acres of chart real estate to cover between here and there, but now that gold seems to be making a change in trend, at least it appears to be changing trends as we speak, if the past is any guide to our future, then gold can cover a 7% chunk of chart real estate to the upside in a relatively short time. Gold was up 3.4% this week alone, so that's not hyperbole. Let's look at a longer-term chart for an example. This current consolidation breakout reminds me of the 2006-2007 consolidation period after gold first cut a $700 price in May of 2006, and then it consolidated for 15 months before breaking out of a similar consolidation then in September of 2007 on its way up to the first rendezvous with $1,000 the ounce 7 months later in March of 2008. When gold finally blasted higher out of that 15-month consolidation, it really didn't quit until it had added $305 or 42% to the definition of new upper resistance back then. That was quite a definition move. Moving to the 3-year weekly subscriber chart, if this current breakout were to follow that same script, we could be talking about gold with a 2 in front of it before this definition move is done. But we are kind of getting ahead of the story again. Let's take a quick peek at the subscriber chart for silver, which did a little blast off of its own this week. No, that's not silver, but that's what it reminded us of this week. And here's the silver 1-year chart, the daily chart for subscribers. Now, did I say a little blast off? That's a 9.7% short covering surge which of course is anything but a little thing. As breakouts go, this one is a keeper. And in a moment, we're going to be looking at how some of the largest traders were positioning going into these important breakouts for the precious metals. Before we do, though, breakouts of this size and violence are never accidental. There are just too many players in the game for a gold market to blast 3.4% higher and silver to gallop nearly 10% higher in a single week unless two things have occurred. The market has to be ready for a trend change psychologically and structurally, and the largest players in the game have to be convinced that the consolidation resistance is no longer valid and that much higher prices are now very likely. Obviously, that is the case now. Let's move to the weekly chart. We can see that once silver got up into the zone where we expected to see strong speculator short covering, the price shot higher, like an Apollo Atlas V rocket. We've been calling for exactly what just occurred in both gold and silver, but was that because of the expected short covering alone? And what did the large commercial traders do once the breakout was underway? Well, since part of the breakout occurred before the CFTC Commitments of Traders report cut off on Tuesday, literally on the breakout day, we can get a glimpse of how the largest traders were positioning just ahead of the largest part of the breakout moves higher. Let's take a quick look at the CFTC Commitments of Traders reports and see what we can learn there. Now, looking first at the legacy COT report for gold for the combined commercial traders, and that includes the producer merchants, the swap dealers, and perhaps some of the other reportable traders from time to time, we can see that as gold had broken out and had added just under $39 the ounce to about $1,637, the traders, the CFTC classes as combined commercials, added a big 27,282 contracts, or about 19%, to their net short positioning. But notice, please, that the open interest only increased by roughly a third of that LCNS increase, a big hint that there was some spec short covering going on. Now let's look at the graph for the large commercial traders. And here's the LCNS graph, the large commercial net short positioning graph. That 27,282 contract increase is the largest LCNS, or large commercial net short positioning, 1 week increase since January 31 of this year, when the combined commercials then added a really big 30,094 contracts net short on a $72 or 4.4% rise for gold to $1,738 then. Incidentally, gold closed at $1,744 the following week, up another $6 in case you were wondering. Briefly touched $1,800 3 weeks later, so the first very large increase in the LCNS was not enough to put the brakes on gold back then. Moving to the LCNS TO, or the large commercial relative net short position relative to the total open interest. And if we look at the relative commercial net short positioning, this week's action includes quite a big jump, a low 37% last week to nearly 43% of all COMEX contracts, a more neutral area on this chart. In other words, the combined commercial traders had net short positions equal to about 43% of all the contracts on the COMEX. In the world we live in today, something close to 30% is very low, and something close to 50% is kind of like a warning. But now let's look a little deeper into the disaggregated COT data, and we'll confine our look to just a few interesting changes this week in the interest of time. Now, we track all of the DCOT data for gold and silver futures, and have since it was first released. Our DCOT data goes back to June of 2006. And from that data, we can build graphs of the action to tell us a lot at a glance. Obviously, there's a lot more going on here than we can possibly cover in a half-hour video, and we want to save some time for a few comments about our favorite precious metal, silver. So let's focus on the most interesting few of the graphs now. First, here's the graph for the traders, the CFTC classes as producer, merchant, processor, and user. The big hedgers, including the largest dealers, the processors, the refiners, and the bullion banks. And remember that the big hedgers are almost always net short because they're hedging. So their position shows as a negative number in these charts. And as the blue line rises, their net short position is going lower, and vice versa. Remember that in the legacy COT report, the combined commercials increased their collective net short positioning by a big 27,282 contracts. Well, believe it or don't, the big hedgers only accounted for 10,864 lots of that LCNS increase this week. The big hedgers did increase their shorts, but not by all that much, relatively speaking, and their net short positioning is a lot closer to a low level than a high level basis the last 2 years. The producer merchants would have to increase their net short positioning by something like 50,000 contracts from here to be close to their highest net short positioning of the year, and that's a lot. So if the big hedgers were not the big sellers this week, who were? That honor, the biggest sellers of gold futures for this week, trophy, goes to the traders, the CFTC classes as swap dealers, the mercenary banks and firms that sell swaps in other markets and then hedge those derivatives using COMEX futures. Swap dealers closed longs and added shorts enough to show a net increase of more than 16,000 contracts on Tuesday, the day gold was going into launch mode. But hold the phone a minute. The mercenary swap dealers are like walking contradictions. Their entire positioning is a hedge of a hedge when you think about it. So if the producer merchants and the bullion banks only added 10,800 contracts new net short, and the swap dealers hedged new long exposure in other markets with new COMEX net shorts to the tune of 16,400 contracts, that legacy 27,000 contract net short increase is not really as bearish as it sounds, is it? At any rate, the swap dealers, which were net long a little bit not very long ago, have now gotten back to a pretty aggressive net short position. But as this graph shows, they've been a heck of a lot more net short in the not too distant past. Let's move on. Here we've moved to the managed money traders, and we know that the funds, the traders, the CFTC classes as managed money, had gotten down to a very, very low level of net long bets on gold recently, and we can see that this week, as of Tuesday, they had added big to their net longs by 24,929 contracts. Again, that's as of Tuesday, and gold has traveled more than $34 higher since then. So they have likely added even more to their net longs. But here's an interesting point. Of that 24,929 contract increase in managed money net longs, it only included 15,585 new long contracts. Drum roll, please. Okay, we don't really have a drum roll sound effect, but if the funds only added 15,585 new longs, that means that the rest of their increase in net longness, if you will, has to be that they covered or offset a big portion of their pure short positions. Let's take a look. And here's that graph. Sure enough, the funds covered a big 9,344, 32% of their short bets in 1 week, from about 28,800 to 19,478 short contracts. Friends, we haven't seen the funds covering that many spec shorts in 1 week since all the way back on September 30th of 2008, when they got out of 9,958 shorts then with $870 gold, and that followed their largest short covering in our records the prior week, September 23rd, 2008, when they got the heck out of a whopping 20,079 short contracts. I don't have to tell you that we here at Got Gold Report pay close attention to when the spec funds are obviously changing their positioning from a high insurance short position, like they had in late May, nearly 41,000 gold shorts, to now less than half of that and falling fast. If we get nothing else from this video report, then let's remember that the funds are now considerably less worried about gold moving lower. This chart proves it. If anything, the action suggests they have had a 180-degree change in mind on that score. The bottom line for the gold COT this week is that we see apparent heavy resistance to gold's trip up to the 1630s as it was breaking out. But when we look inside the data and see that the usual big hedgers had only increased their net shorts by a relatively small amount, and the spec funds were in a New York hurry to get out of their shorts, we really can't look at the data as being anything other than bullish, or at least more bullish than bearish for now. What about silver? Looking again at that beautiful nearly 10% romp for silver, it's clear that the breakout tripped both short covering, the expected short covering that is, and buy stops from the momentum players. We cannot have a 10% jump without both sides of the battlefield on the buy side, even if one side doesn't really want to be there. Looking at the COT data for the legacy large commercial traders in silver, like we did with gold, as silver added $1.50 or 5.4% Tuesday to Tuesday, closing on the cash market at $29.28, the combined commercial traders added a really large 9,075 contracts, or a whopping 38.8% to their combined commercial net shorts, from a low 23,402 up to a much higher 32,477 contracts net short. That's the largest one-week addition to the LCNS since all the way back on September 25th of 2007, when the collective large commercials added a giant 12,939 contracts, or 44%, with $13.28 silver then. Incidentally, the very large increase back then was not a signal of a huge fall to come in silver. Indeed, silver closed flat the following week as it was staging for a rise up to the $20 arena 5 months later. Now let's look at the LCNS graph for silver, but before we do, notice that the open interest for silver futures actually fell for the COT week by 1,217 contracts as the LCNS rose by 9,000. A clear and unmistakable signal that there was significant short covering going on elsewhere, as we'll see in a moment. And here's the silver LCNS graph. Clearly we have left behind the very low, the decade low levels of commercial net short positioning just a few weeks ago, and just as clearly they were indeed contrary bullish, as we have been pounding the table that they were. But now that the LCNS is moving strongly higher along with the price, as shown here, and remember this data is from Tuesday, when silver closed at $29.28, it has increased another $1.50 since then to close Friday at $30.77. The open interest did rise too by Thursday, but only up to 129,496 contracts, which is not all that much higher yet. On the surface, it sure looks like the combined commercials are putting up some strong opposition to the breakout move higher, but like gold, there's a lot more to the story today. Let's look at the LCNSTO graph, the relative commercial net short positioning, which lets us kind of standardize the LCNS data by comparing it to the total open interest. And here's the LCNSTO for silver. Sure enough, we see a big jump higher in the LCNSTO of a big 7.3 percentage points, from a very low 18.1 to 25.4% in 1 week. That's a big jump for this indicator. You have to go back to that same September 25th of 2007 report to find a larger 1 week percentage increase in the LCNSTO, 9.5 percentage points then, and you already know that that ended up not being a bad sign then. To the contrary. Now, if all we had was the legacy COT report, we would have to conclude that the large commercial traders heavily oppose the breakout move for silver and leave it at that. But today, we do have more to consider in the disaggregated COT report. Again, here's the recap for this reporting week, and we can see at a glance that the very large increase in the LCNS was actually a combination of the producer merchants adding 5,164 lots in new net shorts, along with the mercenary swap dealers closing 3,911 of their net longs. let's take a closer look at the producer merchants, the big hedgers, on their graph. Just a few weeks ago, the usual big sellers were near their least net short positioning in years, and it really was bullish as we said it was. Now the producer merchants have increased their net shorts up to about 42,000 contracts, which is no longer at such a low level. As of Tuesday, the big hedgers felt compelled to increase their hedges by quite a bit, but they have quite a long way to go before they would challenge their recent highs in net shortness, closer to 51,000 lots net short. And that's just for starters. Let's look at what the other commercials, the traders classed as swap dealers, were up to this week. The swap dealers recently reported a record high net long position on June 26th of 19,681 silver contracts net long, with silver near $27. By Tuesday, they had pared that long position down by about half to 9,847 contracts on what amounts to an increase of $2.20 the ounce. In the short term, a falling swap dealer net long position can be bullish, as it means that they're actually seeing the opposite condition with their counterparties being closed out. We saw that in the January-February run from $28 to $36, for example. What about the spec funds this week? What about managed money traders in COMEX silver futures? And there's the managed money graph. They're back. Clearly this week the funds saw whatever it is that signals them to add new long exposure in size, as the chart clearly shows that they added a net 6,101 contracts of net long exposure, a 58% increase in 1 week, up to 16,655 contracts net long. Recall that just a few weeks ago the funds had their lowest net long position since 2007, and we were shouting to the rooftops that it was very bullish for that condition to occur with then near $26.50 silver. Well, now hear this, because that 6,101 contract increase in net longs was more than half attributed to a big reduction of 3,487 shorts that the funds covered this week. You can see that in the next graph of just their pure short positions. This is just the short positions for managed money traders. And how about that? Remember, just 4 reporting weeks ago, the spec funds held their highest ever number of insurance short contracts, 17,575 shorts on July 24th, with $26.93 silver. Since then, as silver recovered back up to a $29 handle and was breaking out on Tuesday, they had reduced that high short position down by 8,155 contracts, or 46%, to 9,420 contracts short. Those who have been following our work here at Got Gold Report, we don't have to tell you that we think a falling managed money short position is a strongly bullish signal. It certainly was in 2007, in 2008, and again in 2011, as we can clearly see on this important graph. The takeaway as we run smooth out of time for this report, right or wrong, win or lose, there it is on the graph. The funds had positioned for lower silver prices a few weeks back, but likely only as an insurance position. We know that because throughout the entire period they kept their long positions and just added shorts to hedge them. Now the funds, the managed money traders, are not only adding longs aggressively, they are also covering their shorts aggressively, and that combination, along with some short covering by other traders, can be explosively bullish, as we just saw with silver. Silver has broken out of a bottom consolidation. It powered higher on the short covering we have been looking for, and is now challenging the upper downtrend line of what we believe is a giant 15-month flag consolidation, a view that we have held here since last fall when we first called it the mother of all midpoint consolidations. Given the opposition we see in the COMEX big trader positioning, it would not be all that surprising to see some resistance forming here, and then some backing and filling, But if you think this pop higher was spectacular, and it was that, if this jump higher was fun, then just wait till silver manages to trade to and through about 32.50, well above that giant flag. That, friends and fellow vultures, could be the mother of all breakouts from the mother of all midpoint consolidations, and we could very quickly be talking about silver with a 4 handle, with aggressive short covering, that is, coming in from both sides of the silver battlefield. Having said that, just ahead is a veritable political minefield, both here and in Europe. So easy does it. And, as always, no matter what, mind your stops. We'll leave it there for now. Thanks for watching, and we'll see you all again next time. Oh, before I forget, be sure and take a fresh look at all the Got Gold Report charts, which have all been updated. Bye for now.